Welcome to Heartofeconomy. What if the US suddenly erased nearly 1 million jobs from its history books? On September 9, 2025, that might happen and markets aren't ready. That's the day the Bureau of Labor Statistics will release its preliminary benchmark revision of US payrolls. Many expect it to reveal a massive hidden weakness in the labor market, and that could force the Federal Reserve into its most difficult decision in years. Will the Fed cut rates by the expected 25 basis points, or will it shock the world with a 50-point move? In this video, we'll break down what the revision really means, why it matters so much, how the Fed is cornered, how markets could react, what top economists are saying, and the lessons investors should take away. Let's get started. We all know the monthly job reports, numbers like 150,000 jobs added or unemployment steady at 4%. But there is a truth. Those numbers are based on surveys, and surveys can be wrong. Once a year, the BLS compares its survey results with actual payroll records from employers. If there is a big gap, it issues a benchmark revision, essentially rewriting the labor market story. Sometimes the revision is small, but in times of stress, it can be huge. That's what happened in 2008. Jobs initially looked fine, but later revisions showed the collapse had already begun. Now the risk is back. Whispers suggest the September's revision could be sharply negative, maybe close to 1 million jobs erased overnight. Signs are already flashing. July payrolls were just 73,000, one of the weakest in years. Previous months keep being revised lower. Unemployment is quietly picking up. Put together, it points to a labor market far weaker than the headlines suggest. So what does this mean for the Fed? The Fed has two jobs: price stability and maximum employment. For years, inflation dominated. That's why the Fed hiked so aggressively in 2022 and 2023. Inflation has cooled, but not enough. Now, jobs risk is back. Markets already expect a 25 basis point cut in September. But if the revision is massive, the Fed may have no choice but to consider 50. Powell at Jackson Hole openly flagged downside risks in the labor market, and Governor Christopher Waller admitted if jobs weaken, bigger cuts are on the table. This isn't just speculation, it is coming straight from the Fed itself. If the revision shocks, markets will move fast. Bonds. Yields plunge, the curve steepens. Dollar could weaken from rate cuts or strengthen if recession fears push global investors into safe haven mode. Equities. First they cheered cuts, then reality sink in. Why did the Fed panic? That could flip a rally into a sell-off. Gold and Bitcoin. Safe havens thrive when trust in the system is shaken, but could surge. Mohamed El-Erian. 25 basis points is baseline, but 50 is possible if the data collapses. Nouriel Roubini warns of stagflation risk. Cutting too fast may reignite inflation. Larry Summers focus on credibility. If the Fed looks panicked, trust in its judgment erodes. Goldman Sachs adds their baseline is still 25, but they caution that a 1 million job revision could tip the balance. Together, these voices capture the Fed's dilemma: save jobs, protect credibility, or keep fighting inflation. No choice is easy. Right now, markets are split. The baseline, a 25 basis point cut in September, is virtually guaranteed, but speculation is building around something bigger. Here is the key. This isn't just about numbers on spreadsheet. It's about market psychology. If the revision is small, the Fed cuts 25 basis points and everyone breathes easier. But if it is huge, investors split into two camps. One camp says, fantastic, bigger cuts mean cheaper money and stocks will fly. The other says, wait, if the Fed is panicking, does that mean the economy is much weaker than we thought? That tension alone could fuel volatility across bonds, currencies, and equities right up to the Fed's decision. In my view, if the revision knocks out only a few 100,000 jobs, the Fed will likely stick with 25 basis points. But if the number creeps toward a million, at that point, a 50 basis point cut stops being speculation and becomes necessity. So what can investors take away from this? I break it into three layers. First, the size of the revision. Small revisions are noise, but a massive revision, that's a clear signal that the economy has been overstated, and it forces portfolio adjustments across the board. Second, the breadth. Is it just manufacturing? Then maybe it's isolated, but if the revision spans services, tech, construction, and manufacturing together, there's systemic weakness, and systemic weakness ripples through stocks, credit markets, even housing. Third, the Fed's message. Sometimes what Powell says matters more than the data itself. If he says we are acting decisively to protect jobs, markets may rally, at least for a while. If instead he insists we haven't forgotten about inflation, then that really could fizzle in minutes. My advice? Don't rush. In moments like this, the first move is often the wrong one. Wait for confirmation. See how the Fed frames the narrative. Then act. And remember, this is not investment advice. It's a simple reminder that in volatile times, patience and discipline are worth more than predictions. To wrap up, the coming payroll revision isn't just a technical adjustment. It's a potential turning point for the Fed, for markets, and for the global economy. Here at Heartofeconomy, we'll keep cutting through the noise to give you the clearest picture of what really matters. If you found this analysis useful, don't forget to subscribe to the channel, hit the like button, and turn on notifications. Because in finance, nothing is ever as simple as it looks, and we'll always bring you the story behind the story. Stay tuned. See you in the next time.